This video is for all those investors who believe that the markets are disconnected with the realities on the ground. Markets are high and economy is struggling. There is nothing wrong in this thought process. We are logical animals after all. For example, let's say you go down to buy a kg of apple from a fruit vendor nearby and he or she quotes you rupees 100 per kg. Your first reaction, whether you do it consciously or not, just note it, is why is it so expensive? Itna महंगा क्यों है? It's a general tendency of a buyer to believe that the price of the item in question is high. Of course, if not for MRP. It doesn't matter if it is an 100 rupee item or worth crores. We as investors or buyers always believe in seeking value for every purchase of ours. The same logic applies to the markets as well. Given a choice, many of the people that I know would not buy at these levels if not for SIP. They keep complaining, they keep telling you that markets are expensive and I will buy only if it falls by 5, 6, 7%. Again, nothing wrong. Just that now your mind starts approving this thought. It then starts giving you evidences to tell you that your thoughts are correct. One of the reasons many investors today give me is that the realities on the ground and the market are not correlating with each other. This is one of the most common reason people are not investing today. That's why I thought in this video I will share 4 simple charts to prove that your thought may not really be correct. And I thank Jeff Reed and Mr. Sunil Singhania for bringing this excellent article to us. As a government, I have to worry about only 2 things, revenues and expenditures. Let us now have a look at both these major heads and try to figure out the real state of Indian economy. First, on the central tax revenues, we are up 83% year on year. Now you may say that last year was a washout. Then let's compare it with Q1 of 2019, and the good news is that we are up 29% as against Q1 of 2019 too. The direct tax revenue is up 41% while the indirect tax is up 19%. Great news on the tax revenue front, on the central tax revenue front. Let us now shift to GST. GST has always been a good sign of economic recovery, economic sustenance. We have always believed that GST will show you the realities of the ground, and you can see it that the last few months have been excellent on the GST correction side, right? And therefore, we believe that the recent central tax revenue mop-up can be sustainable too. So we have covered revenues. Now let's cover expenditures. On the spend side, this is something which shocked me too, is that we are down 5% against 2019 numbers, and of course we will be substantially down against year-on-year numbers, primarily because last year was a complete washout, national lockdown. There was a lot of support that the government had given to people, right? And the good news is that the capex spends are up 15%. The rails and road spend is up 66%. This should lead to sustainable economic recovery on the cyclical sectors. I strongly believe so. So if you see, the capex is up 15% and discretionary spend is getting lower and lower. Very good for the economy. And finally, what does this lead into? It leads to fiscal deficit, of course, right? So the higher tax revenues, lower expenditures, and large upfront RBI dividend makes us believe that the fiscal deficit will well be contained. I will not be shocked if the final fiscal deficit number will be lower than estimated, as you can see from the chart. Therefore, this also leads us to believe that the debt yield may not really cross 6.5%. Great news for investors, because today, if I were to go and invest in equity, I would also compare with other investments like debt and real estate, and if those yields are lower, I will push more and more money to equity, thereby pushing the markets even further up. To conclude, I honestly don't know whether the markets are rightly valued, overvalued, undervalued. But when I see the valuation numbers and compare them with the historical averages. Of course, as an investor, it is scary to invest at these levels. Definitely. But one thing which I've always learned in the last 18 years is that the markets are always forward looking. And therefore, if you are one of them who believes that the recent economic recovery is not just due to pent up demand but can also lead to sustainable long term demand leading into capex cycle, go ahead and invest. Always remember there are going to be undervalued sectors, more so in bear market and less in bull market, but can offer you great returns at much lower risk. Go ahead, invest into them. Be a part of this greatest bull run India has ever seen. Don't miss the bus.